Hello. Yeah, hi Anu. Just give a thumbs up if you are able to see the presentation as well as hear me also. Anu?
Yes, sir.
You are able to hear and see the presentation, right? Give me a thumbs up. I am not able to hear you. Okay, perfect. So we just started. So just to introduce the chapter, business value, and I was mentioning that in a way my style has been throughout the sessions to concisely cover the study material context and the text, so that in a way while hearing my sessions you are referring or covering the study material also and studying the study material also. So all my presentations are in a concise way of the study material context. So business value is influenced by factors such as, first of all, obviously the business value comprises of or is influenced by the following factors like quality of the business, profit potential, economic environment within which that particular business is functioning or is operational, and industry influence. Obviously as the business is part of which industry, that also matters most, whether it's a sunrise industry, whether it's a futuristic industry, or whether it's typically a conventional industry in which the particular business falls, and accordingly the valuation gets impacted. So one is these factors typically influence the business valuation also, as at the same time it impacts the business valuation also. So in short, the three key steps in company valuation would involve economic environment analysis, secondly industry influence analysis, and thirdly, most importantly, obviously the company analysis itself. And the asset valuation principles which typically are normally covered in the concept of business valuation is that value is equal to present value of expected returns, and precisely because it's about expected returns, it requires estimation of expected return stream, and secondly the required rate of return for discounting, because we have to calculate the present value. So while calculating a business value, value will always be constituted as the present value of future earnings or expected returns or earnings by that business or by that business organization for that matter. And secondly, the required rate of return at which those expected returns should be discounted so as to arrive at the present value. So that's what value, the asset valuation principle always means. Value is equal to present value of expected returns, and for that it requires estimation of expected return stream and the required rate of return for discounting. So continuing with the valuations itself, or the introduction part itself, the valuation techniques are categorized into three main approaches. So in business valuation, the valuation techniques are normally categorized into three main approaches. First is the income approach, which uses discounted cash flow methods and is precisely based on the present value of operating cash flows, free cash flows. That's one approach, which is income approach. Second approach is the market approach, wherein the usage of relative valuation techniques are used, for which it compares with similar companies based on the earnings, cash flow, book value or sales. So there has to be some comparative analysis with the similar companies or peer companies, or you can say rival companies for that, or competitors also for that matter. But the predominantly comparative or comparable factors would include earnings, cash flow. There has to be some similarity. So either the similarity will be established or the relationship will be established on the basis of earnings, cash flow, book value or sales of each company and the peer company. That's what is the market approach, precisely the relative valuation technique. And third approach, which is normally covered as a valuation technique, is the cost approach. Now in this cost approach is based on replacement or reproduction cost. Now this cost approach is applied when a company is new with limited future potential or company is in a liquidation stage. So in these two scenarios, typically the cost approach is considered. Now comes typically the application of income approach heavily relies on the concept of discounting. or application of capital budgeting techniques, because you have to estimate the future cash flow or future earnings. Therefore, a lot of capital budgeting techniques have to be used. At the same time, the present value of those future earnings have to be also derived based on the rate of discounting that will be applied, and therefore the whole income approach application heavily relies on the concept of discounting or application of capital budgeting techniques. It is advisable to brush up the concepts for a better understanding of valuation under the income approach for the students. That's the note which has been mentioned in the study material also. So while understanding the various methods, it's a typo which I am correcting side by side. So it is advisable to brush up the concepts for a better understanding of valuation under the income approach. Now, which concepts? Typically the present value, capital budgeting techniques, what is meant by discount rate, etc. And that any which ways we are going to cover in the syllabus also. So the discount rate per se. So discount rate is used to calculate the present value of future cash flows in an inflationary economy. So when the economy is in an inflationary mode, a rupee today is worth more than a rupee in the future due to declining purchasing power. So that's the indications of the inflationary economy. So a rupee today is worth more than a rupee in the future due to declining purchasing power is the indication of inflationary economy. This concept is explained by the time value of money principle. So again, these are the concepts that you should, as a student, while preparing for the examination, refresh yourself. Now these concepts are typically part of financial management also, or strategic cost management also, or strategic financial management also, or advanced financial management. So just brush up the concepts simultaneously. Any which ways, whatever has been covered in the study material, I have tried to concisely put across and will be covering in the section for today. So then interest compensates. So depositors and lenders for the time value of money. At the same time, investors for foregoing current spending in expectation of future returns. So these are the aspects of interest compensation between the depositors and lenders for the time value of money. The calculation of discount rate. Now calculation of discount rate typically is equal to risk-free rate plus risk premium, which reflects cash flow risk. So this is the formula which is normally used for arriving at the discount rate. It is based on investment characteristics and may be adjusted for the investor's expectations. In business valuation, discount rates are often represented by the cost of capital. The cost of capital is the minimum return a company must achieve to create value for its financiers, lenders, preference shareholders and equity shareholders. So this is briefly what is meant by discount rate. Now let's get into the various concepts. So as I said that it is necessary to brush up the various concepts that are involved. So we are brushing up with the concepts or walking you through the various concepts. The cost of capital, which is critical, as the discount rates are often represented by the cost of capital. So cost of capital, let's see, represents the cost of funds for financing a business. It is the return required by the suppliers of capital, namely bondholders and owners or promoters. So if financed only by equity, then, just a second, if financed only by equity, that is KC, represented by KC, then cost of KC is equal to cost of equity. And if it is only financed by debt, then it is cost of capital is equal to cost of debt, that is represented by KD. So weighted average cost of capital, that is called as WACC. So WACC normally formula is, it is used when typically companies are financed by a mix of debt and equity. So if both sources of finance are being used, then typically the formula would involve WACC, that is WACC is equal to weighted equity into KE plus WD plus KD into 1 minus T, T is the time, plus WP into KP. So that's the WACC formula. Key points while applying discounted cash flow techniques. Use WACC because free cash flow belongs to all the stakeholders. Discount cash flows after taxes as free cash flows are after tax. Prefer market values for weightage if unavailable. Just a second. So yeah, these are the key points while applying discounted cash flow technique. So prefer market values for weights. If unavailable, then use the book values. Base weights on target capital structure at maturity stage. Match discount rates, either real rate for real cash flows or nominal rate for nominal cash flows. Nominal is always preferred. Adjust for systematic risk for each capital provider. So these are the few key points which are there. Now definitions of weights typically. So WE is equal to value of equity divided by market value of debt plus market value of equity plus market value of preference capital. So that's the formula. WD is equal to value of debt divided by the denominator remains the same, and WP is equal to value of preference capital divided by the denominator remains the same. So note which has been given under IFRS or Ind AS, preference shares may be classified as either debt or equity based on the issue terms. Simplified WACC formula, if only debt and equity is involved, then WACC is equal to cost of debt into market value of debt divided by total market value plus cost of equity into market value of equity divided by total market value. For example, Alpha Limited, debt is equal to, let's say, rupees 30 million and equity is equal to rupees 45 million. Then pre-tax KD is equal to 11%, KE is equal to 16.5% and tax rate is 30%. Then in a way WD is weighted is 0.40 and 0.60. The weightage that has been given is 0.40 and 0.60. So in such scenario, WACC would be 0.40 into 0.11, that is 11%, into 1 minus 0.30, that is post-tax, plus 0.60 into 0.165 is equal to 12.98% is the discount rate that is, or the WACC that is arrived at. The cost of debt, so this is cost of capital in a way, or the definition of weight that is in a way we have tried to explain. Then comes cost of debt represented as KD. It is the interest rate paid by a company on its debt. Obviously no debt is free and therefore the interest cost will be always the expense or the cost of debt. So the interest rate paid by a company on its debt is the cost of debt. It represents the rate at which the company can borrow funds on the valuation date. If current borrowing rate is unavailable, there are certain alternative approaches that can be used, and these approaches are by way of practice. So the key variables affecting cost of debt are, one is the risk-free rate. So higher risk-free rate, then higher is the higher tends to higher cost of debt. The default risk and default spread are nothing but higher default risk represents higher borrowing costs because default spread may vary with the loan maturity. Then comes after tax cost of debt. So interest expense is always a tax deductible expenditure, and therefore formula wise after tax cost of debt is equal to pre-tax cost of debt into 1 minus tax rate. So as to arrive at after tax cost of debt. Obviously it's a simple formula. Example, borrowing rate let's say is 11%, tax rate is 30%. Then after tax cost of debt is 11% into 30%, 1 minus 0.30, that is 1 minus 30% is equal to 7.7% is after cost of debt. So pre-tax cost of debt is 11% and after tax cost of debt is 7.7%. Then comes the concept of cost of equity, that is represented as KE. It is the return expected by equity investors for their equity investments. Unlike lenders, there is no clear contractual return. Obviously, when equity shareholders infuse capital, there is no contract per se that has been entered between the company and the shareholders. Therefore, there is no contracted rate as such or return that is expected, unlike bondholders or preference share capital also for that matter. Unlike lenders, there is no clear contractual return, but investors demand a return for bearing the risk. So obviously the investors, equity investors expect some kind of a dividend always. being the being a return for bearing the risk that is involved in the business that they have put into the money. Then comes the concept of capital asset pricing model called as CAPM. So CAPM typically is a widely used model to estimate cost of equity. So for cost of equity estimation, CAPM is the model that is normally used. It focuses on systematic, that is non-diversifiable risk. Now what is meant by diversifiable risk, non-diversifiable risk, etc. we have already seen in the strategic performance management. So with that intent, I am not getting into that. So focus of CAPM is always on the systematic risk, and CAPM formula is equal to cost of equity, that is KE, is equal to risk-free rate plus beta into equity risk premium. Now let's understand what are the these concepts, risk-free rate, etc. So this is the CAPM formula. Now components typically of this CAPM formula is the risk-free rate. So return on a risk-free investment, example 10-year government bond yield, and beta measures a company's stock return sensitivity to the market return. Equity risk premium, that is ERP, is nothing but additional return demanded by the investors for choosing equities over risk-free assets, and it is calculated as market return minus risk-free rate. For example, risk-free rate is equal to 7.5% and market return, let's say BSE Sensex wise, is 15%. Then the company's beta is equal to 1.2 and company's beta is equal to 1.2. Then the required rate of return on equity, that is KE, is equal to 7.5% plus 15% minus 7.5% into 1.2 is equal to 16.5% is the required return on equity, that is KE. Now let's understand the concept of unsystematic risk and systematic risk versus systematic risk. Now unsystematic risk is specific to a company or industry, also called as unique or diversifiable risk. Specific to a company or industry, also called as unique, diversifiable and firm specific risk. Now unsystematic risk can be eliminated through diversification. Systematic risk typically means market wide risk, also called as non-diversifiable risk, cannot be diversified away. So risk diversification is not possible in such cases, and it applies to both individual securities and portfolio also. So total risk is equal to systematic risk plus unsystematic risk. Now let's understand what is meant by beta. Beta measures the sensitivity of a stock's return relative to the market return. So how a typical stock is giving returns to the that particular stock investors vis-a-vis the market. So it's a comparison of an individual stock, return on individual stock vis-a-vis the entire market return per se. That's the sensitivity measured is called as beta. Higher the beta, if the beta is more than 1, then the stock is more volatile than the market, and especially this is seen in luxury goods companies or FMCGs as such. So low beta, when the beta is less than 1, is low beta, so it shows or reflects that stock is less volatile than the market. Example, utility companies. So it's a more like a slow moving stock and really doesn't in a way not volatile at all than the market, and therefore example wise the utility companies typically fall under or normally have a low beta. The beta formula, therefore beta is equal to covariance of stock and market returns. Just a second. Yeah. So beta formula is covariance of stock and market returns divided by the variance of market. The deviation is 25%. The covariance with market is, let's say, 0.05. Then beta is equal to 0.05 divided by 0.25 square is equal to 0.8 is the beta. So it's typically the covariance of stock and market returns divided by the variance of market returns. So that's what the formula of beta is. Then let's see the build-up model. So build-up model is especially used for private companies, used when beta is not available. Obviously, because it's very difficult to, if the company is not listed, then it's very difficult to gauge the beta. And in such case, build-up model is used. So being private company, there will never be a market return that can be assessed. And therefore, build-up model is used when beta is not available. For that, the formula is cost of equity is equal to risk-free rate risk-free rate plus equity risk premium plus size premium plus company specific premium, and the factors that are involved are equity risk premium is nothing but market return over risk-free rate, size premium is higher for smaller companies, company specific premium is considered to account for the risks that are unique to that particular private firm or the company, additional considerations are controlling versus minority interest or lack of marketability, etc. So basis these factors, the beta is calculated or the cost of equity is calculated. Now adjusted cost of equity is another concept that we will try to understand. The expanded CAPM formula to incorporate additional risks. Yeah, sorry. So formula precisely is there. Cost of equity is equal to RF plus beta into bracket MRR minus RF plus KS plus KI plus KZ plus KT plus KL plus KM plus K cyclical. Now what exactly where KS is sovereign risk, KI is the industry or sector risk, KZ is the size risk, KT is the technology disruption risk, KL is the location specific risk, KM is the management risk, and K cyclical is the cyclical risk because of the product life cycle. The important aspect over here is it's important for private equity funds, conglomerates and others setting a hurdle rate of return for investments. Then comes the popular dividend discount model or called as DDM. So in dividends, cash flows are received by shareholders. Company value is equal to present value of expected future dividends. So the key points over here in this model are a shareholder's investment today is based on the present value of future dividends. Even if the shareholder sells before liquidation, the sale price reflects the present value of future dividends, and therefore DDM value is generally less volatile and reflects the long-term earning potential of the company. Obviously, in this model there are certain disadvantages also. This DDM is not applicable for companies not currently paying dividends. So if at all there is no dividend that is being paid by the company itself, it's very difficult to apply the dividend model as such, dividend discount model for valuation. Depends heavily on the dividend policy of that particular company also, which minority shareholders cannot control. If the dividend policy aligns with profitability, then DDM is appropriate. If not aligned, then dividends are a poor proxy for future cash flows. When dividends, so these are the limitations of or disadvantages of DDM. When dividends are an appropriate measure, so in that case the company has a consistent history of dividend payments. There is a clear and earnings linked dividend policy, and the valuation is from a minority shareholders perspective. In such scenario, dividends are an appropriate measure. Perpetual dividend. So let's understand this concept of perpetual dividend. It assumes that shareholders hold the shares indefinitely. The value of shares is the present value of an infinite stream of dividends, and the formula typically is V0 is equal to D1 divided by R, where, just a second, where V0 represents the present value of shares, D1 represents the dividend per share, and R represents the required return on equity. For example, constant dividend, let's say, is ₹3 per share annually. Expected return expected return is equal to 12%, and the value of shares is V0. So the key point in perpetual dividend typically is that an assumption is dividends remain constant forever, and challenge is that this assumption may be difficult to justify in real world scenarios. So these are the key points of perpetual dividend. Then comes the Gordon growth model, that is GGM. The concept wise, it assumes dividends grow at a constant rate forever. Each year's dividend is discounted based on its expected growth and required return. The formula is V0 is equal to D1 divided by R minus G. G is the dividend growth. So that's the distinction between perpetual dividend and Gordon growth dividend model, where V0 represents the present value of shares, D1 represents the dividend expected next year, R represents the required return on equity, and G represents the dividend growth rate. For example, next year's dividend is ₹3 per share. Expected growth rate is 6%, then the required return is 12%, then value of shares is V0 is equal to 3 divided by 0.12 minus 0.06 is equal to ₹50 per share. The key point over here is the growth rate G should be lower than the required return rate. So that's what the key aspect in Gordon growth model is. And second point is that it is unrealistic to assume perpetual growth at a rate higher than GDP growth plus inflation. The advantages of Gordon growth model are applicable to stable, mature, dividend paying companies, suitable for valuing market indices and listed companies, simple and easy to understand, useful for calculating price implied growth rates and required rates of return. Can be used to supplement other more complex valuation models. However, having said so, though there are advantages of GGM, there are limitations also of GGM, and these limitations are typically the model is highly sensitive to estimates like dividend amount, growth rate and required return, all hard to predict accurately. Therefore, there will be always a element of error or estimation involved, and it is not applicable for non-dividend paying companies. Obviously, GGM will not be useful for those companies valuation where those companies are not paying dividends at all, and unreliable for companies with unstable or unpredictable growth patterns. So these are the limitations of GGM. Then comes another model, which is, so we are in a way looking into various models of valuation. So multi-stage dividend discount model, that is called as DDM. Reality check, constant growth as assumed by the Gordon model is often unrealistic for most companies. The companies typically experience multiple growth phases, and the life cycle of the business is initial growth phase, high profits, low or no dividends, heavy reinvestments, because it's in the initial growth phase. Then comes the transition phase where profits and dividends grow but slow down as competition increases, because slowly the business is coming to a maturity. Mature phase is stable, slower growth, profit, dividends stabilize with maintenance level reinvestments. Then comes the two-stage dividend discount model. Thank you. Yeah, please excuse me, I am having my evening tea. Thanks. So two-stage dividend discount model assumes high growth rate for a short initial period and normal perpetual growth afterwards. It is suitable when high growth period is limited and foreseeable. So these are the assumptions of two-stage dividend model. Please excuse me, because it's a live recording that is happening, but at the same time I can't deprive myself from the tea. That is my normal tea, because I need some rest for my throat also. So in H model, refinement of the two-stage model. So H model is nothing but a more refinement to the two-stage dividend discount model. It assumes high initial growth that declines gradually, linearly over time to a stable long-term rate. Of course, this model is more realistic for companies whose competitive advantage erodes progressively rather than abruptly. For example, a company starting at a 25% growth, declining by 5% each year, and stabilizing at 5% by year 4. So in a way, that's what the H model is all about. Then comes the discounted cash flow model, or popularly known as DCF model. It's a bit elaborately covered in the study material also. It's a huge concept. It's very difficult to concise it and in a crisp manner, but I have tried the best to put it in a concise manner over here. So obviously, as a part of your exam preparations, you will have to refer to the study material and the various examples and illustrations that have been given in the module, because in section B typically the numerical problems really starts from module 7 and 8 typically, because in module 6 it's entirely theoretical, because we are looking into the laws and compliance of business valuation. So accordingly, kindly my humble suggestion will be, please, I haven't covered in my session the problems as such, because it's very difficult to cover the problems out over here in a what you can say, monologue kind of a mode, because for problem solving there has to be some interactive interaction between the students and the faculty also, which is missing over here, and hence I am not covering illustrations or the problems or the solved cases that are being elaborately explained in the study material. My humble suggestion is, along with this theoretical knowledge that I am imparting in the sessions or I am covering the sessions, you must refer and solve each and every problem, or understand how the problem has been solved in the study material itself. So kindly read or hear the session along with the study material problems. So discounted cash flow models. So let's understand the concepts various. So free cash flow, FCF, actual cash available to investors, and those investors are typically the shareholders and the bondholders after necessary reinvestments. So this represents the internal funds that can be distributed without harming the company's ongoing operations. Applicability works for most of the companies, regardless of dividend policy or capital structure also. Especially useful for companies not paying dividends or where dividends don't align with the earnings. Of course, like every other model, this model too has challenges. So companies with high capital investment needs high capital. So if the company is capital intensive, if with high capital investment needs may show negative free cash flow for several years, because the huge amount of investments would have happened in the business. So because they are being like infrastructure companies, huge amount of capital. So typically in capital intensive company, and in such situation, the company may show negative free cash flows for several years. In such cases, the company's value is heavily dependent on terminal value, making DCF less reliable. So these are the challenges for DCF model also, that it is not really useful or relevant for capital intensive companies. The key variants of FCF used are the free cash flow to firm, that is FCFF, which means cash flow available to all investors, whether it's debt or equity holders. And second variant is FCFE, which is free cash flow to equity, which means cash flow available only to equity shareholders after debt obligations. So these are the two variants of free cash flow, which is the essential part of the discounted cash flow model. Now let's understand both the variants. So free cash flow to the firm, FCFF, the definition wise, it's a cash available to all suppliers of capital, debt holders, equity holders, preference shareholders, after paying operating expenses excluding interest and after making necessary investments. Then comes the firm valuation. So firm value is equal to present value of forecasted FCFFs plus terminal value discounted at weighted average cost of capital, that is WACC. The formula has been given down below, where FCFF T is equal to free cash flow to firm in year T. Case is the WACC and N is the explicit forecast period. Thereafter, the study material has mentioned the steps to calculate FCFF. I have tried to summarize the steps. The step starts with the PAT, that is profit after tax. Add to it the non-cash charges like depreciation, amortization and non-cash tax losses. Subtract from that the capital expenditure, that is CAPEX, minus net of fixed assets purchase and sales. Further subtract the working capital investments, that is changing in current assets minus current liabilities, and add to it the tax adjusted interest expense. So let's understand the important components of this FCFF. PAT, typically PAT is profit after tax. So after depreciation, amortization, interest, income taxes, preference dividends. Non-cash charges are add back non-cash expenses like depreciation or losses. Subtract non-cash gains, example, gains on asset sales. Capital expenditure, that is CAPEX, is the cash spent on acquiring fixed assets netted with proceeds from asset sales, if any. And working capital investments is the increase or decrease in net working capital, which impacts available cash flows. The data sources for capex typically are the cash flow statement, which includes typically the investment or investing activities section. So cash flow generated from investing activities will give the information about capex, and change in gross or net fixed assets plus depreciation are the data sources for capex. Now let's see the working capital investment in FCFF calculation. So working capital investments refers to change in non-cash working capital over the period. It measures the net increase or decrease in operational assets and liabilities. Non-cash working capital, that is NCWC. The formula is NCWC is equal to current assets excluding cash. Just a second. Minus current liabilities excluding short-term debt. Yeah, so NCWC is or rather non-cash working capital is equal to current assets excluding cash minus current liabilities excluding short-term debt. And working capital investment calculation, the formula is working capital investment, that is WCI is equal to NCWC in year N minus NCWC in year N minus 1. N is the number of years forecasted. Exclusions are typically the cash and cash equivalents. Excluded, why are they excluded? Because changes in cash are the output of FCFF calculation, not an input. That's the logic behind exclusions of cash and cash equivalents. And short-term debt and current portion of long-term debt are also excluded. Why excluded? Excluded as they are financing activities. Just a second. And they bear explicit interest cost and they are not operating activities. That's why they are excluded. The reason for deduction: cash spent on acquiring additional working capital is not available for distribution to providers of capital, that is debt or equity holders. So that's the logic because of which the deductions are happening. Now let's see the tax adjusted interest expense in FCFF calculation. Why add back tax adjusted interest itself? So the purpose of adding back the adjusted tax adjusted interest is basically interest expense is already deducted while arriving at PAT. That's one of the reason, so that there is no double deduction. And FCFF reflects cash available to all capital holders including the bond holders also. Therefore after tax interest expense is equal to interest into 1 minus tax rate must be added back to PAT to avoid double counting. So that's the logic behind adding back the tax adjusted interest. Calculating FCFF from cash flow from operating activities, that is CFOA. FCFF formula using CFOA is FCFF is equal to CFOA plus interest into 1 minus tax rate minus capital expenditure. So these are the formula typically to be used for calculation of FCFF. So we are going through the one variant of free cash flow and understanding the free cash flow from firm. The important considerations in this are that CFO already adjusted for non-cash charges and working capital investments. Tax, the treatment depends on the accounting classification also. If interest is classified as operating activity, then add back after tax interest expense to CFOA to compute FCFF. If interest is classified as financing activity, no adjustment for interest is needed as CFOA doesn't deduct it. Then comes the second variant of free cash flow, FCF, typically which is the FCFE, that is free cash flow to equity. Let's understand this now. So definition wise, cash available to equity shareholders after meeting debt obligations and capital expenditure reflects the company's capacity to pay dividends, useful for valuing both dividend paying and not dividend paying companies. The FCFE formula from profit after tax is FCFE is equal to profit after tax plus non-cash charges minus capital expenditure minus working capital investments plus net borrowing. So the key difference from FCFF is that FCFE adds net borrowing instead of adding tax adjusted interest. The FCFE alternative calculation methods are from CFOA, FCFE is equal to cash flow from operations minus capital expenditure. Just a second. Plus net borrowing. And from FCFF is equal to FCFE is equal to FCFF minus tax adjusted interest expense plus net borrowing. That's how the calculation are being done of FCFE alternative calculation methods. Then comes the just a second. Concept of terminal value. So let's understand what is meant by terminal value. Terminal value in DCF valuation typically. Why terminal value? Because it captures value beyond the explicit forecast period and it recognizes that companies cannot grow at higher rates indefinitely. That's the logic behind it, and that's why a particular point in time where the value of that particular company freezes, or it's like the end of the explicit period or explicit forecast period. At that end of the explicit forecast period, what will be the terminal value of that particular business? Methods for calculating terminal value are no growth model. If the model is no growth model, then terminal value is equal to FCF divided by R. FCF is equal to applicable free cash flow, either FCFF or FCFE, and R is equal to applicable discount rate, whether it's WACC for FCFF or cost of equity for FCFE. If the model is a stable growth model, then terminal value is equal to FCFN plus 1 divided by R minus G. Just a second. So again, more detailed this thing would be there in the study material. I've just tried to concise it for the purpose of session. Limitation and time limitation also. So terminal value is equal to FCFN plus N divided plus 1 divided by R minus G. Where FCF N plus 1 is the free cash flow in the first year after the forecast period, R is the applicable discount rate, and G is the expected long-term stable growth rate. So important aspect over here is that stable growth rate G should always be less than the discount rate. So that's a word of caution one has to observe while the valuation is being done, especially the terminal value. So this was about terminal value. Then let's see another discounted cash flow model wherein relative value multiples in valuation are considered. Now this concept typically let's understand. Instead of projecting cash flows indefinitely, a multiple is applied to financial metric. Now this financial metric could be earnings or sales or book value in the terminal year to estimate the terminal value. Common multiples that are used are price to earnings, that is PE multiple, especially applied to earnings. Price to sales, that is P divided by PS multiple, that is applied to revenues. And price to book value, which is P divided by BV, is multiple which is applied to book value. Usage, so this relative value multiple is typically used, particularly useful when it is hard to estimate a stable cash flow growth rate. And secondly, it provides a market-based estimate by comparing with similar publicly traded companies or historical industry averages. Then comes the let's understand the difference between FCF models and dividend discount models also. FCF model is free cash flow model. Take a controlling interest perspective. Free cash flows represent cash that can be redeployed by a controlling shareholder without impacting necessary company operations. A minority shareholder may also rely on FCF models if there is a possibility of acquisition. As acquisition prices typically reflect the control premiums. Secondly, dividend discount models, DDM, take the minority interest perspective. So this is there is a difference in perspective that is followed in FCF model. FCF model takes a perspective of controlling interest, and this dividend discount model takes the perspective of minority interest. In DDM, it is assumed that shareholders cannot influence dividend payouts, and it is suitable when dividends are primary expected return. Control premiums are not reflected in the DDM valuations. Then comes the concept of adjustment for cash and non-operating assets. So equity value calculation starts with the value of operating assets obtained from discounting FCFs, add cash and cash equivalents available for the acquirer, and non-operating assets like excess land, investments or subsidiaries not contributing to FCFS. This adjusted sum gives the total equity value. So these are the concepts of discounted cash flow models. Now we will have a distinction between the two approaches, FCFF in a snapshot. So the FCFF approach versus FCFE approach, so comparative analysis which has been given in the study material itself, I have tried to reproduce and in a crisp manner, summarizing it also at the same time. The first is profit after, so I will highlight the distinctions between the two methods. In both the approaches the starting point is PAT. In both the approaches we add the non-cash charges, we reduce the capital expenditure, we reduce the investment in non-cash working capital. In FCFF we add the interest post-tax, and in FCFE approach we add the net borrowing, which gives, the sum gives free cash flows to the firm, that is FCFF and FCFE per se. So these are first 6 steps gives us the FCFF and FCFE. Then we calculate the present value of FCFF discounted at WACC, and in the present value of FCFE is discounted at cost of equity. To that we add the present value of terminal value. Then we add the cash and cash equivalents. Then in both the approaches we add the value of non-operating assets. And then in such case, in case of FCFF approach, we arrive at the value of the firm, that is the company. From that we reduce the debt, that is the current value, which gives us the value of equity. Now these two last steps, that is 11 and 12, value of firm, because it's all about value of free cash flow from equity, therefore the value of equity. So that's the distinction between the two approaches in terms of value of firm and reducing the debt current value. So the key points to be remembered under FCFF is that one must find the firm value, then subtract debt to arrive at the equity value. Whereas under FCFE, one directly find the equity value without needing to subtract debt separately. because debt obligations have already been considered in the cash flows through net borrowing adjustment. So that's the distinctive points to be kept in mind for FCFF and FCFE approach. Now over here the chapter is completed, or the syllabus of this chapter is over, or the theory part of this chapter is over. Thereafter at the end of the chapter on discounted cash flow, or chapter number 1 of module 7, includes short question and answer and long question and answer. As a practice matter, I have been summarizing the concepts that have been discussed in that short answer. So these are the short answer summary. So in first question and answer, 3 valuation approaches have been discussed. First is the income approach, which uses discounted cash flows to value future cash flows today. Second is the market approach, which uses market multiples, example PE or PB, to value based on comparable companies. Third approach is the cost approach, wherein values based on the cost of replacement or reproduction used for new or liquidating firms. Then in second short question and answer, WACC calculation example has been given using formula WACC is equal to WD into cost of debt into bracket 1 minus tax plus weighted equity into cost of equity. Result is 12.98%. Cost of equity via CAPM is calculated. So in question number 3, where cost of equity is equal to risk-free return plus beta into market return minus risk-free rate rather, and result answer is 12.8%. Fourth short question and answer deals with concept of beta. Beta typically indicates sensitivity to market movements. A higher beta reflects higher market risk and useful for portfolio risk return balancing. Then fifth short question and answer talks about limitations of dividend discount model, that is DDM. This model is typically not usable for non-dividend paying firms, and it assumes minority shareholder view may under state the true value also. So these are the limitations over here of the DDM model. Then sixth question and answer talks about DDM valuation example. So formula is P is equal to D1 divided by cost of equity minus growth rate. In that example, let's say $2 divided by 15% minus 5% is equal to $20. And then comes the concept of CAPM, which has been discussed in the question number 7. So CAPM cost of equity example, calculation 2% plus 1.2 into 10% minus 2% is equal to 11.6%. Then the long question answer summary, in a way I have tried to summarize it over here. The first question talks about impact of economy and industry on valuation. So macroeconomic factors like inflation, interest rates, and industry specific factors like competition, tech regulation, influence valuation are considered and impacts the economy and industry on valuation. Second long question answer talks about applying dividend discount model. So over here DDM uses projected dividends discounted at the cost of equity to estimate stock value. And secondly, third talks about the assumption in DCF, that is the discounted cash flow. So the assumptions that have been discussed in question number 3 about DCF are the forecasted cash flows, discount rate, growth rate, terminal value, and the risks or tax assumptions are key. Then WACC calculation problem creation is mentioned in long question and answer 4, where it uses capital components, especially equity, debt, preferred stock, and cost to calculate WACC using weighted average formula. In question and answer 5, long question and answer 5, role of beta in CAPM is discussed. Beta reflects systematic risk. Higher beta increases cost of equity in CAPM and affecting the valuation. In question number 6, systematic versus unsystematic risk is discussed. So unsystematic risk is diversifiable, not used in valuation, whereas systematic risk is market related, used in capital asset pricing model to determine expected returns and equity valuation per se. So the key points typically, sorry, this is again my mistake, copy paste that has happened. Yeah, so with this, in a way, we end the chapter. I have tried to cover up the entire theory portion which is there in this chapter and the theoretical concepts. So just to quickly summarize and do a wrap up in a way of the session. We started off with the understanding of what exactly business valuation means. Then we saw the 3 key steps in company valuation, which involves economic environment analysis, industry influence analysis and company analysis also. Then we saw through the 3 main approaches that are the valuation techniques follow: income approach, market approach and the cost approach. We obviously saw that highlight note that application of income approach heavily relies on the discounting rate and application of capital budgeting techniques. It is advisable to always brush up the concepts for a better understanding of valuation under the income approach. Then we saw the discount rate. What is meant by discount rate is used to calculate the present value of future cash flows in an inflationary economy. A rupee today is worth more than a rupee in the future due to declining purchasing power. This concept is explained by the time value of money principle. Interest always compensates, so depositors and lenders for the time value of money and investors for foregoing current spending in expectation of future returns. Calculation of discount rate typically is equal to risk-free rate plus risk premium, which reflects cash flow risk. It is based on investment characteristics and may be adjusted for the investor's expectations. In business valuation, discount rates are often represented by the cost of capital. Cost of capital is the minimum return a company must achieve to create value for its financiers, lenders, preference shareholders and equity shareholders also. Then we saw the cost of capital, which represents the cost of funds for financing a business. It is a return required by suppliers of capital, namely bondholders and owners. If financed only by equity, then cost of equity. If financed by debt, then cost of debt. That is the cost of capital. We then saw the weighted average cost of capital for concept in short called as WACC. So WACC is used when companies finance through mix of debt and equity, and the formula is down below. Key points while applying the discounted cash flow techniques. Use WACC because free cash flow belongs to all stakeholders. Discount cash flows after tax as free cash flows are after tax. Prefer market values for weights. If unavailable, use book values. Base weights on target capital structure at maturity stage. Match the discount rates, real rate for real cash flows and nominal rate for nominal cash flows. Nominal is always preferred. Adjust for systematic risk for each capital provider. Then we saw the definition of weights, weighted equity, weighted debt and weighted price. So note, under IFRS and Ind AS, preference shares may be classified as either debt or equity based on issue terms. Simplified WACC formula, if only debt and equity, is WACC is equal to cost of capital into market value of debt divided by total market value plus cost of equity into market value of equity divided by total market value. Then we saw an example whereby WACC was calculated. The cost of debt is the interest rate paid by a company on its debt. It represents the rate on which the company can borrow funds on the valuation date. If current borrowing rate is unavailable, then there are alternative approaches that can be used. Key variables affecting cost of debt includes risk-free rate. Higher risk-free rate means higher cost of debt, and default risk and default spread. Higher default risk means higher borrowing cost, which means default spread may vary with the loan maturity. After tax cost of debt means the interest expense is tax deductible, and formula is after tax cost of debt is equal to pre-tax cost of debt into 1 minus tax rate. For example, if the pre-tax cost of debt is, or borrowing rate is 11% and tax rate is 30%, then after tax cost of debt is equal to 11% into 1 minus 0.30, that is equal to 7.7%. Then we saw cost of equity represented by KE. It is a return expected by equity investors for their investments. Unlike lenders, there is no clear contractual return, but investors demand a return for bearing the risk. CAPM model, a widely used model to estimate cost of equity. It focuses on systematic, that is non-diversifiable risk. The CAPM formula per se is cost of equity is equal to risk-free rate plus beta into equity risk premium. The components involved are the risk-free rate, that is return on a risk-free investment, example 10-year government bond yield. Beta is measures a company stock return sensitivity to the market return, and ERP, that is equity risk premium, means additional return demanded by investors for choosing equities over risk-free assets, calculated as market return minus risk-free rate. For example, risk-free rate is 7.5%, market return BSE Sensex is 15%, company's beta is 1.2, and then the required return on equity, that is KE is equal to 7.5% plus 15 minus 7.5% into 1.2%, that is the company beta, which gives to 16.5% as the ERP. Then we saw the distinction between unsystematic risk and systematic risk. Unsystematic risk is specific to industry or company and hence also called as unique, diversifiable or firm specific risk. It can be eliminated through risk diversification. Systematic risk involves market-wide risk, also called as non-diversifiable risk, cannot be diversified away and applies to both individual securities and portfolio. Total risk is always equal to systematic risk plus unsystematic risk. Then we understood the beta concept. Beta measures the sensitivity of a stock's return relative to the market return. So how a particular stock is giving returns vis-a-vis the overall market return is what the concept of beta is. So it's a sensitivity of a particular stock's return to the overall market return. Higher the beta, which is more than 1, then stock is more volatile than the market per se. For example, luxury goods companies are always on having high beta. Low beta means less than 1, which shows that stock is less volatile than the market. Example, utility companies. The beta formula is beta is equal to covariance of stock and market returns divided by variance of market returns. Example, we have already seen numerical example how it is calculated. Then we saw the build-up model. The build-up model for private companies typically when used when beta is not available. Formula is K is equal to risk-free rate plus equity risk premium plus size premium plus company specific premium. Factors that are involved in this calculation are equity risk premium is the market return over risk-free rate. Size premium is equal to higher for smaller companies, and company specific premium is to account for risks unique to a particular private company. Additional considerations that are considered in this build-up model as the controlling versus minority interest as well as the lack of marketability of the respective equity. Then we saw the adjusted cost of equity, expanded CAPM formula to incorporate additional risk, and this is the adjusted cost of equity formula, wherein KS is equal to sovereign risk, KI is the industry or sector risk, KZ is the risk size risk, KT is the technology disruption risk, KL is the location specific risk, KM is the management risk, and K cyclical is the cyclical risk, that is the product life cycle risk. Important for private equity funds, conglomerates and others setting a hurdle rate of return for investments. Then we saw the dividend discount model. Dividends typically are cash flows received by shareholders. Company value is equal to present value of expected future dividends. The key points in dividend discount model are that a shareholder's investment today is based on the present value of future dividends. Even if the shareholder sells before liquidation, the sale price reflects the present value of future dividends, and therefore DDM value is generally less volatile and reflects the long-term earning potential of the company. There are certain disadvantages of DDM. Not applicable for companies not currently paying dividends, depends heavily on dividend policy which minority shareholders cannot control. If the dividend policy aligns with profitability, DDM is appropriate. If not aligned, dividends are a poor proxy for future cash flows. When dividends are an appropriate measure, the company has a consistent history of dividend payments. There is a clear and earnings linked dividend policy. The valuation is from a minority shareholder's perspective. Perpetual dividend, then we saw the concept assumes the shareholder holds the shares indefinitely. The value of shares is the present value of an infinite stream of dividends. Formula is V0 is equal to D1 divided by R, where V0 is equal to present value of the shares, D1 is equal to dividend per share, R is equal to required return on equity. Example, as we see, key point assumption dividends remain constant forever. Challenge is that this assumption may be difficult to justify in real world scenarios. Then we saw the Gordon growth model, GGM. Concept wise, it assumes dividends grow at a constant rate forever. Each year's dividend is discounted based on its expected growth and required return. Formula wise, V0 equals to D1 divided by R minus G, where V0 represents the present value of shares, D1 is the dividend expected next year, R is the expected required return on equity, and G is the dividend growth rate. Example, we have seen key point, the growth rate should be lower than the required return. It is unrealistic to assume perpetual growth at a rate higher than the GDP growth plus inflation. Advantages of Gordon growth model, GGM, applicable to stable, mature, dividend paying companies, suitable for valuing market indices and listed companies, simple and easy to understand, useful for calculating price implied growth rates and required rates of return, can be used to supplement other more complex valuation models as well. Limitation of GGM are highly sensitive to estimates like dividend amount, growth rate and required return, all hard to predict accurately, not applicable for non-dividend paying companies, unreliable for companies with unstable or unpredictable growth patterns. Multi-stage dividend discount model, DDM, reality check, constant growth as assumed by Gordon model is often unrealistic for most companies. In such case, multi-stage dividend discount model is applied. Companies typically experience multiple growth phase. So initial growth phase, high profits, low or no dividends, heavy reinvestments. So multi-stage dividend, so at each stage of the cycle of the business, the dividend is in a different fashion that is being considered. Transition phase, profits and dividends grow but slow down as competition increases. Mature phase, stable, slower growth profit, slower growth, profit growth, dividends stabilize with maintenance level reinvestments. Then we saw the two-stage dividend models where it assumes high growth for a short initial period and normal perpetual growth thereafter. Suitable when high growth period is limited and foreseeable. H model is refinement of the two-stage model. It assumes high initial growth that declines gradually linearly over time to a stable long-term growth rate. More realistic for companies whose competitive advantage erodes progressively rather than abruptly. Then we saw example. Then we came to discounted cash flow models wherein free cash flow concept was discussed, actual cash available to investors, shareholders and bondholders after necessary reinvestments, represents internal funds that can be distributed without harming the company's going operations. Applicability works for most companies regardless of dividend policies or capital structures, especially useful for companies not paying dividends or mere dividends don't align with the earnings. Challenges are there. Companies with high capital investment needs show slow negative free cash flows for several years. In such cases, the company's value is heavily dependent on terminal value, making DCF less reliable. Key variants of FCFF, we saw FCFF, that is free cash flow to firm, which means cash flow available to all investors, debt plus equity holders. Free cash flow to equity, which means FCFF, FCFE, which means cash flow available only to equity shareholders after debt obligations. Then we saw both the variants wherein free cash flow to the firm, the definition we saw how the firm valuation is to be done, the formula for FCFF, the steps to calculate FCFF include starting with PAT, add non-cash charges, subtract capital expenditure, subtract working capital investment, add a tax adjusted interest expense. Then we saw the various concepts and important components of FCFF, which includes PAT, non-cash charges, capital expenditure, that is CAPEX, working capital investment or data sources for CAPEX also. Then we saw the working capital investment in FCFF calculation. Working capital investment refers to change in non-cash working capital, that is NCWC, over the period, measures the net increase or decrease in operational assets and liabilities. Non-cash working capital formula, we saw current assets excluding cash minus current liabilities excluding short-term debt. So the working capital investment calculation formula we saw, working capital investment is equal to NCWC in year N minus NCWC in year N minus 1. Exclusions are cash and cash equivalents are excluded because changes in cash are output of FCFF calculation, not an input. And short-term debt and current portion of the long-term debt is also excluded as they are financing activities. They bear explicit interest costs, not operating activities. Reason for deduction is obviously cash spent on acquiring additional working capital is not available for distribution to providers of capital, whether they are debt or equity holders, irrespective of that. Then we saw the tax adjusted interest expense in FCFF calculation. Why add back tax adjusted interest? Especially because interest expense is already deducted while arriving at PAT, and therefore FCFF reflects cash available to all capital providers including bondholders. Therefore after tax interest expense, that is interest into 1 minus tax rate, must be added back to PAT to avoid double counting. Then we saw the calculating FCFF from cash flow from operating activities, that is CFOA, and that's the formula. The important considerations are that a CFOA already adjusts for non-cash charges and working capital investments. Treatment depends on accounting classification. If interest is classified as operating activity, add back after tax interest expense to CFOA to compute the FCFF. If interest is classified as financing activity, then no adjustment for interest is needed as CFOA doesn't deduct it. Then we saw the free cash flow to equity, another variant of free cash flow. The definition wise, cash available to equity shareholders after meeting debt obligations and capital expenditure reflects the company's capacity to pay dividends, useful for valuing both dividend paying and non-dividend paying companies. FCFE formula is from PAT plus non-cash charges minus capital expenditure minus working capital investment plus net borrowing. So the key difference from FCFF is FCFE adds net borrowing instead of adding tax adjusted interest. FCFE alternative calculation methods are there. From CFOA, FCFE is equal to cash flows from operations minus capital expenditure plus net borrowing. From FCFF, FCFE is equal to FCFF minus tax adjusted interest expense plus net borrowing. Then we saw the terminal value in DCF valuation. Why terminal value? Captures value beyond the explicit forecast period, recognizes that companies cannot grow at high rates indefinitely. The method for calculating terminal value in no growth model, terminal value equal to FCF divided by R. R is the applicable discount rate. It's WACC for FCFF and cost of equity for FCFE. And in stable growth model, terminal value FCFN plus 1 divided by R minus G. Then we saw that important aspect that stable growth rate G should always be less than the discount rate. Then we came to the concept of relative value multiple in valuation. Instead of projecting cash flows indefinitely, a multiple is applied to a financial metric, either earnings, sales or book value in the terminal year to estimate terminal value. And in that case, common multiples used are price to earnings multiple, price to sales multiple and price to book value multiples. Usage is particularly useful when it is hard to estimate a stable cash flow growth rate and provides a market-based estimate by comparing with similar publicly traded companies or historical industry averages. Then we saw the difference between FCF models and dividend discount models. FCF model, typically free cash flow models, take a controlling interest perspective. Free cash flows represent cash that can be deployed by a controlling shareholder without impacting necessary company operations. A minority shareholder may also rely on FCFF's model if there is a possibility of acquisition, as acquisition prices typically reflect control premiums. And then DDM takes the minority interest perspective. It assumes shareholders cannot influence dividend payouts. It is suitable when dividends are the primary expected return and control premiums are not reflected in the DDM valuations. Then we saw the adjustment for cash and non-operating assets. Equity value calculation involves start with the value of operating assets obtained from discounting cash flows, free cash flows, add cash and cash equivalents available for the acquirer, and non-operating assets like excess land investments or subsidiaries not contributing to FCFFs. This adjusted sum gives the total equity value. Thereafter, we saw the comparative between the FCFE approach and FCFF approach. Now, these are the comparatives. So, typically, I am not just reading out. The crux is under FCFF, you first find the firm value, then subtract debt to arrive at the equity value. Whereas in under FCFE, one directly finds the equity value without needing to subtract debt separately, because debt obligations have already been considered in cash flow through net borrowing adjustments. Thereafter, I took you through the various short answer summary and the concepts covered in therein. In the first one, it is covered the three valuation approach. In second, it is the WACC calculation example. In third, it is the cost of equity via CAPM. In fourth, the concept of beta was explained. In fifth question, limitations of dividend discount model were discussed.